Welcome to The Explainer. Today, we're digging into one of the most expensive mistakes any investor can make. And nope, it has nothing to do with picking the wrong stock. We're talking about the overconfidence trap, a tricky psychological bias that gets almost everyone. And believe me, when you see the numbers, you'll see just how costly it can be. You know, this old quote from the 19th century humorist Josh Billings it completely nails the problem. The real danger isn't the stuff we don't know. It's the stuff we think we know for sure that turns out to be flat out wrong. And when your money's on the line, that kind of misplaced certainty, well, it can cost you big time. So how does this trap actually show up in the real world? Well, let's kick things off by looking at a huge study that analyzed thousands of real investors. And what they found was pretty eye-opening. Okay, take a look at this. Researchers dug into over 35,000 brokerage accounts, and they found this massive gap. Men were trading 45% more often than women. They were turning over their portfolios way more aggressively. I mean, that is a huge difference in behavior. So, that immediately brings up the million-dollar question, right? Is all this extra activity, all this buying and selling, actually working? Does being a more active trader really lead to better returns? The researchers crunched the numbers to find out. And the answer was a loud, clear no. Actually, it was the complete opposite. All of that frequent trading hurt men's net annual returns by 2.65 percentage points. That's money they would have had if they had just done less. And women weren't off the hook either. Their trading also cost them, but you can see it was by a lot less, about 1.72 percentage points. The data is pretty undeniable. The less they traded, the smaller the hit to their returns. So, what in the world is going on here? Why would one group trade so much more, actively hurting their own bottom line? Well, the researchers concluded it had basically nothing to do with skill. It was all about a powerful psychological bias. And the main culprit they pointed to is overconfidence. It's this very human tendency to believe that our own knowledge, our own abilities, are just a little bit better, a little more precise than they really are. When it comes to investing, it's that little voice in your head telling you you've got the secret sauce to beat the market. And you know what? The stock market is the perfect breeding ground for this bias. I mean, think about it. Picking winning stocks is ridiculously hard. Forecasts are notoriously unreliable. And when you make a trade, the feedback you get is messy. Was that winning trade a stroke of genius or just pure dumb luck? That ambiguity is exactly where overconfidence loves to grow. The study also pointed out that psychologically, men tend to be more overconfident in fields that are seen as male-dominated, like finance. But wait, the story doesn't stop there. The data gets even more specific, and it really shows just how big of a deal this can be when we break it down a bit further. Okay, so check this out. When the researchers isolated single investors, to take out the potential influence of a spouse, the gap turned into a giant chasm. Single men traded a staggering 67% more than single women. And that directly impacted their performance, costing them an extra 1.44 percentage points every single year compared to single women. So let's be super clear about the main takeaway here. The study wasn't saying that one group was better at picking stocks. In fact, both groups actually lost money by trading too much. The only real difference was that men did it more often, which just magnified all those little costs, like commissions and bad timing. It's a huge lesson in how that financial friction can seriously wear down your wealth over time. All right, so this brings us to the real challenge for every single investor out there. You obviously need some confidence to make a decision, but too much is a disaster. So how do you build genuine, healthy confidence without falling into that dangerous trap of overconfidence? The best way to think about it is like you're walking a tightrope. On one side, you've got underconfidence, where you're just too timid, too scared to ever make a move. On the other side, you have that reckless overconfidence, where you're trading way too much. The real goal is to find that perfect balance, right there in the middle. So how do you actually stay on that tightrope? Well, it's about building your confidence the smart way. First, and this is non-negotiable, you manage your risk. Make sure a few bad calls can't wipe you out. Second, start slow. Don't try to do everything at once. Just stick to a few simple, solid strategies. Third, get real experience. And that means navigating the markets for years through the ups and the downs, not just a few good months. And finally, and this one might be the hardest, you have to stay objective. Take your ego out of the equation. A winning trade doesn't make you a genius, and a losing one doesn't make you an idiot. Look, just knowing this bias exists is a huge first step. So for this last part, let's turn the mirror around and think about what this might mean for your own personal style as an investor. So be honest with yourself for a second. Which one of these sounds a little more like you? Are you a rosy glow optimist? Someone who kind of expects things to work out and might be a little more likely to overestimate your own skills? Or are you more of a defensive pessimist? Someone who's always managing expectations, thinking about what could go wrong? Because believe it or not, that little bit of pessimism can actually be your secret weapon against the overconfidence trap. At the end of the day, it all comes down to asking yourself this one critical question. Are my investment decisions built on a solid foundation of experience, discipline, and objective analysis, or are they just being fueled by an emotional and potentially very expensive illusion of knowledge? Getting that answer right could make all the difference for your success in the long run.